Group with breaking news. Our July read on Producer Price Index. Expecting up 0.2 on headline, exactly what we received. No revision to the up 0.1 in the rear view mirror. Strip out the all-important food and energy, a surprise here. Down 0.1. Mirror image of the 0.1 up we're expecting. And boy, what a reversal from up 0.3 last month. Ex-food and energy trade down 0.1. Final demand year over year 1.7. Food and energy, ex-food and energy year over year up 2.1. And even though this is really on the low side, it does happen to be the 24th 2 or higher number in this series. So a long time with the 2 handle. And ex-food and energy trade year over year 1.7. That's a little bit light as well. Everybody's talking, of course, about how China's producer prices moved lower unexpectedly year over year, even though their CPI is moving higher. It's going to be interesting to see if we have any mirror image of that as we get CPI, of course, next week. Just to give you a perspective on how big of a week it's been, and I know we had a great bounce in Treasury yields, but we gave a lot of the second part of that bounce away yesterday after the auctions. We settled at 185 in 10s last week. We're down 15 basis points. We settled at 238 last week in 30-year bonds. We're at 222. The dollar index is one of the few areas that has had a downward drift, but yields have had more than a downward drift. They've had an anvil drop. Melissa Lee, back to you.
Thanks, Rick. Initial market reaction, we're seeing a slight bid lower on the futures across the board in the equity markets, as well as a slight pressure on the U.S. 10-year yield here. Steve is here with more on this.
Yeah, I think this is sort of a neutral report in that it's kind of in line with the year-over-year numbers, the ex-food and energy, 2.1. CPI and PPI have been tracking pretty well together, which has been kind of interesting. There's some trade in this number, right? What you've had some pressure on the middlemen, and they show up, that their profit level shows up in this number here. That number was down with the most recent round of actual tariffs put in place. It fell. In other words, their profit margin declined. So you ask, well, who's paying them? Those folks who were in charge of importing stuff, and their margins got hit a bit. Also, when you look at import price data from China, this is how we know that Americans are paying the tariff. Because import price data would have to fall an equivalent amount equal to the tariffs for the Chinese to be paying it. So this data show, both the PPI data and this data show that it's being paid on this side of the border.
So it's an interesting point, though. You're right, Steve. This number incorporates the tariffs, a little bit of the tariffs so far. The next round of tariffs are going to be on consumer goods. Do you worry that that's going to be even a bigger driver of inflationary pressure?
So I forget the quote that Richard Clarida, the vice chairman, said. They increase prices but not inflation. Tariffs are a one-off rise in the price level unless you keep raising tariffs on a continuing basis, or unless you change the psychology of people about the outlook for prices,
right,
drive up expectations. You would not change the inflation, which is a growth rate. It's not an actual level. So I'm not worried about that. In fact, most of the Fed guys that I talk to say this is really a deflationary phenomenon. You've upset supply chains, you've upset trade back and forth, and basically dislocated a lot of activity, and that tends to be a deflationary phenomenon. I think we should take one quick look, if we have a minute here, at the outlook for the Federal Reserve as we close the week. And I think what you'll find is there is a 100% probability that we'll be talking about a rate cut come September. And very interestingly, we may not have this data here, something like a 70 or 80% probability we do another one in October. This is a new phenomenon.
So that went higher because
it's
wasn't
been
it just
going
64%
higher
the other day when you were here?
Yeah, let me call this up because we may not have the chart in the back there. It takes me a second here. And then it's like a 60% probability that we have another one in January. So a third cut from now, that's been bouncing back and forth, the 50% probability between December and January. Quiet time is now for the Federal Reserve, and then it opens up in Jackson Hole in a couple weeks' time. We'll get a lot of Fed commentary out of that, and then we've got another stretch of time of data and other stuff to work out. But there's 3 cuts built in, and again, the question will be the question we had before. Does the Fed push back against the markets, or do they let the market run with its feelings about what's going to happen next? I'm getting cake. I'm getting a really big cake. It's coming. It's going to be a huge cake. It's going to be chocolate, and that's the way the market is thinking. And the Fed has not said to the markets, you're not getting cake. Or if you're getting cake, you're not getting as big a piece of the cake as you think. And if you're not getting well, it's not going to be as much chocolate as you think. The Fed has not said any of that.
Is it a chocolate cake?
Kind of cake that you wanted.
Like.
Any cake you like.
Because it's cake that the markets want.
Right.